alaikum, sir, and anyone else who might be watching right now. We're from Group F of the Basic Accounting Principle. This is our group assignment, and we are about to present to you financial statements, its importance, and adjusting accounts. Without further ado, I'd like to first and foremost introduce our group members. Now that that's done, let's get right to it. Financial statements are formal written records that explains the business activities and the financial position of an entity. Financial statements are usually audited by government agencies, accountants, and firms. Set of statements provide the profitability, equity of ownership, financial position or status, and cash operation of an entity. Statements are prepared based on recorded transactions which are intended for users of financial information. It consists of four main statements. The first statement is the statement of profit and loss. The second statement is the statement of owner's equity. The third statement is the statement of financial position. And the fourth statement is the statement of cash flow. Statement of profit or loss reports the financial performance in terms of the company's revenue and expenses over a specific period of time based on the matching concept. Statement of owner's equity reports the details in the movement or changes in the owner's equities over a period of time. Statement of owner's equity is prepared after the statement of profit or loss. Statement of financial position presents the financial position consisting of a list of the assets, liabilities, and owner equities for a specific date. And finally, the statement of cash flow. The statement of cash flow is a summary of cash receipts and cash payments, which presents the movement in cash and bank balances for a specific period of time. The movement of cash flow is classified into sections of operating activities, investing activities, and financial activities. It is also important to note that out of the four statements, only the statement of financial positioning is recorded on a specific date. All of the other statements, which is the statement of profit or loss, the statement of owner's equity, and also the statement of cash flow, are recorded over a specific period of time.
Assalamu alaikum, my name is Nurainaa Kamilah Binti Zalizan. I will now be presenting the importance of financial statement. Financial statements are, as explained, a collection of summary level reports about a company's financial performance. Firstly, the financial statements serve its importance towards the management. The management team requires up-to-date, accurate, and systematic financial information. Financial statements help the management to understand the position, progress, and the prospects of business vis-a-vis the industry. By providing the management with the financial statement, it enables them to formulate appropriate policies and courses of actions for the future. The financial statements also have a significance toward the shareholders and investors. Published financial statements are the main source of information for the prospective investors. These statements enable the shareholders to learn about the efficiency and the effectiveness of the management and also the earning capacity and the financial strength of the company. By analyzing the financial statements, the prospective shareholders and investors could ascertain the profit and earning capacity, present position, and the future prospects of the company and make a decision about the investments in the company. The financial statements are also important to the public and to the national economy. Business is a social entity. Various groups of society, though directly not connected with business, are interested in knowing the position, progress, and the prospect of a business enterprise. It is through the published financial statements are for the public to analyze, determine, and form an opinion or make a decision upon the business enterprise. As stated, the financial statement provides the general public with information to which they can examine and analyze the worth of a company and avoid being scammed too. Financial statements are also essential for regulatory bodies to avoid manipulation of income or expense, such as tax authorities, register of companies, and so forth. The economy is protected by ensuring the business entities strictly follow the regulations and also whether the regulations are fitting and appropriate. Thank you.
Assalamualaikum and hello everyone. My name is Siti Najwa binti Rusli. I will continue this presentation with the explanation about three types of financial statement, which are statement of profit or loss, statement of change in owner equity, and statement of financial position. Firstly is statement of profit or loss. The statement of profit or loss is a one-off financial statement that provides a summary of a company's revenue, expenses, and profit. It gives an insight into how a company operating, whether it had the ability to generate the profit. For the profit or loss for the automobile workshop Sdn Bhd, the service revenue for Mr. BKAN and Mrs. Sheila was RM215,000. The expenses was include wages expenses RM81,250, utilities expenses RM11,000, rent expenses RM8,000, insurance expenses RM500, miscellaneous expenses RM1,200, depreciation expenses for building RM20,000, depreciation expenses for equipment RM6,250, and supplies expenses RM5,000. So the total of their expenses was RM133,200. After deducting the revenue with total expenses, they made a profit of RM81,800. Thus, their profit was considered as net profit because their income exceeds their expenses. Next is a statement of change in owner equity. The statement of change in owner equity, also known as statement of retained earning, is one of the financial statements that shows all change in equity for an accounting period. It reflects all changes in equity between the beginning and the end of the accounting period, arising from transactions such as new capital investment, the dividend paid, owners' withdrawals, net profit or loss, and fixed asset revaluation. As an example, Mr. BKAN and Mrs. Sheila's capital on 1 January 2019 was RM179,000. There were withdrawals cash of RM1,000 for business during the year. They have a net profit about RM81,800. After the capital, RM179,000 and net profit RM81,800 were added and then deducted with the drawing RM1,000. The capital that recorded on the 31 December 2019 was RM259,800 during the year ended of accounting period. The capital in owner equity is increased by the owner contribution and income, while decreased by withdrawals and expenses. And last but not least is statement of financial position, which is a list of the assets, liabilities, and owner's equity as of a specific date. The financial position is to provide information about the result of the operation, financial position, and cash flows of an organization or company. Finally, we can know the financial position for automobile workshop, which we can see the total of assets and liabilities are both same, which are RM298,050. The equation of total assets and liabilities indicates how the assets was funded either by borrowing money or using the owner's money. Overall, the statement of financial position shows how automobile workshop manage its assets and liabilities, and also shows the amount of capital invested and the profit or loss that incurred by Mr. BKAN and Mrs. Sheila. That's all from me. Thank you.
Adjusting entries are a very important part of the accounting cycle because they ensure that you are reporting the company's financial situation accurately. Adjusting entries are journal entries made at the end of an accounting cycle to update certain revenue and expense accounts and to make sure you comply with the matching principle. The matching principle states that expenses have to be matched to the accounting period in which the revenue paying for them is earned. There are four main types of accounts that need to be adjusted: prepaid expenses, accrued expenses, unearned revenue, and accrued revenue. Adjusting entries help to ensure first, the income statement of the company only reports revenue that the company earns during the accounting periods. Second, receivables in the balance sheet reflect the true amount that the company has the right to receive at the end of the accounting periods. Third, income statement includes the expenses and losses that a company incurs during the accounting periods. Fourth, balance sheets consist of the liabilities that the company incurs as of the end of the accounting periods.
Now I will explain about adjusting entries. Adjusting entries is one of the steps in accounting cycle. Is the process called adjusting entries. Accountants record these journal entries in the general ledger accounts and usually prepare them at the end of the financial year after the preparation of trial balance. Every adjusting entry involves change in revenue or expense accounts as well as asset or liability account. Adjusting journal entries can be classified into three main types, which are prepayments, accruals, and non-cash expenses. Adjusting entries affect one real account and at least one nominal account. All adjusting entries will affect either an expense account or a revenue account. I will explain about adjusting entries. Adjusting entries for automobile workshop in terms of billing that is due from others in accordance to the account receivable is 40,000 ringgit. The amount owed to others from the account payable is 31,000 ringgit. The investment for business issued by Mr. BKAN and Mr. Sheila are converted to capital in the amount of 259,800. Other expenses are then converted to miscellaneous expense. For depreciation expense, which count accumulated depreciation minus building divided by 5, which is 222,300 minus by 25,000 divided by 4 equal to 20,000. Amount in the adjusted trial balance is 458,500. From the assignment that we do, we can conclude that accounting is also termed as accountancy, that deal with processing of financial information, measuring and recording of certain financial transactions. It also includes analyzing of certain economic entities. It is the most important function of any business. Accounting can also further divided into other branches like management accounting as well as cost accounting. It is responsible for all the kinds of monetary transactions that help in taking most of the major management decisions. For any successful business, the accounting team should be highly efficient. The number of members in the accounting team depends entirely on the size of the business. So that we can summarize that accounting is very important for the most company to ensure loss or profit. Accounting is the recording the financial transactions in the books of accounts, classifying the transactions into different heads and subheads, summarizing the accounting data into reports and financial statements, and interpreting the financial data to assist decision making.